everyone. Welcome back to another episode of AWM Insights. It's your Power 3, 2 CPWAs, and a CFA. We are Erik, Brandon, and Justin. And we have some exciting news this week on a few different fronts. First and foremost, on Wednesday of last week, we had the UK to become the first country to approve the vaccination, and this week it should be rolling out. On another front is we've had some positive momentum and conversations around the stimulus package, and we're really going to get into how does that impact us on the short term, yes, from getting cash to a lot of people, but really what are the long-term implications for your portfolio and the potential of the economy. And then another really interesting thing is around the unemployment claims. And so the data, we're trying to figure out what should we actually trust, because we hit a pandemic era low as far as the employment claims, but also had some differing data come out last Friday.
Yeah, so just starting on the employment side of things, Erik, the new jobs report for the whole month of November was not as optimistic, if you will, as the unemployment claims you just highlighted were. So that data came out on Friday, and the number of new jobs created in the U.S. was around 245,000. The expectation was somewhere around 400,000. So a pretty big miss. Now, it is important to highlight that this data is generally pretty noisy. So you see that with unemployment claims. It was a better number, low 700s, as you highlighted. The previous 2 weeks were higher than expected. So these data points move around quite a bit. You really need to look at the trends as opposed to any specific data point if you're really trying to figure out what's truly going on in the economy. So the unemployment numbers are mixed, I guess is fair to say. Now, the new jobs being added are not as strong as they've been in the past, but that's kind of been expected, just given what's going on with the virus. Now, you compare that to the vaccine news, and markets are pretty optimistic, right? They're forward looking. They're looking out 6, 12, 18 months even in some cases, and they see the light at the end of the tunnel. To your point, it's the vaccine is rolling out in the UK. It's probably going to roll out here in the US by the end of the year, by the end of the month here in December, and markets are pretty dang hopeful on that front.
Yeah, I think that's a fantastic point too, is the markets are a voting machine for the future, right? And that's kind of goes back to the stimulus question. We got a question from a client earlier today. With all this stimulus, that has to be good for markets, right? And I think, it's too difficult to say. The markets are going to adjust to whatever the impact is there. And while they may be very beneficial short term, and I think that's largely, why the decisions being made to introduce some stimulus is to help buoy the economy, to help get businesses or keep businesses open through such a difficult period of COVID. But what we know about markets is that they absorb information quickly. And so, as these details come about, what the stimulus is going to bring from a short-term perspective, markets are looking longer term and trying to figure out and adjust to what that ultimate impact is. And, I reminded that client today, this is why we don't try to predict the short term, right? It's a fool's game to try to figure out, hey, does this stimulus or these job numbers, whatever it is, what's the impact going to be in the very short term? Because it's anybody's guess, quite frankly. And so, that long-term nature seems to be the way to go. And I'd love, even around the stimulus, what are some more thoughts on that and how you'd approach, or how we approach that from a long-term perspective?
Yeah, it's complicated. It's hard to see and forecast really, or predict exactly what the impact's going to be on portfolios long-term. Additional debt is not necessarily a good thing longer term, and that's kind of what the Republicans have hung up on. Now, you have to balance that with the fact that we're going through a pandemic, and there's kind of a trade-off between two just bad options, right? More debt, or shutting down the economy, impacting the economy, hurting households and individuals. But from a long-term perspective, you can't time that. You can't really predict what the impact will be on portfolios. So you invest according to the long-term principles that we highlight time and time again, right? Control what you can control. We have generally high quality fixed income in our portfolios. We're going to diversify around countries. So, we're talking US here and adding debt to the US debt pile, if you will, but we're not just US based investors. We actually have exposure to countries throughout the world. And some of those countries are in a lot better fiscal shape than the US, and some, quite frankly, are in worse shape. And, you kind of weight your exposure to those countries accordingly. So I would summarize it really as remaining diversified, not trying to predict how the market's going to react to certain things like adding more stimulus over the long term, because it truly is, like Brandon said, and we've said time and time again, a fool's errand. There are so many variables that go into long-term performance that a specific point in time right now, can it have an impact? Certainly. The size of that impact is just incredibly difficult to really measure or forecast.
And the thing I hear you talking about, which is so helpful, is going back to the fundamentals. What are the core principles of having a successful investment experience? Is understanding the long-term nature of your investment strategy. But that can be really difficult because when I turn on the news, depending on what station we listen to, or even just different podcasts, talking about the data, we started this episode talking about how there might be conflicting data just even around unemployment. And it's really the danger of trying to make short-term decisions on what specific report said or what's going on in the economy. We covered this in previous podcasts, that the stock market and the economy are not in lockstep on a daily basis, right? And I think one of the questions I do have for the audience is they are making adjustments to their plans. Where does this stuff show up in their long-term plan? One of the things we talked about, are we stealing returns from the future to be able to bolster our returns today? I've heard that being one of the things when we have Fed manipulation. Where for the end investor are their plans going to show up differently from the impacts and the decisions that are being made today?
Yeah, I mean, one point on that quickly is the importance of financial structure. We've talked about this previously, but really having a good understanding of what outcomes you're trying to achieve, what priorities you have, because, I think that drives so many different things, and it drives, what you need to make sure you have for tomorrow, and allows you to become a long-term investor, right? And, these short-term fluctuations, how it impacts all this short-term, I mean, nobody knows. Do we expect it? And then when you're putting your plan together, it's having, systematic, realistic expectations for the portfolio for the future, right? You should expect some sort of market premium for investing. Like if you're going to invest in stocks, like you expect to be rewarded for that. There's other premiums that should show up. Small companies outperforming large, or value companies outperforming growth over long periods of time. So, you need to stack those things on top of each other when you set your expectations for the future. But when we're in periods like this, what we also know is that where we're starting from, in the past, maybe we were starting from a higher real rate assumption. Now we're in a period where interest rates are so low, inflation is still present. And so, we're potentially even starting from a negative situation. And when you add additional debt to the system, and Justin can certainly speak to this probably more eloquently than I can, but you add debt to the system, it affects that real rate. It affects your starting position. So I think it all certainly goes, should be taken into account. But again, that can only be looked at over a long period of time. I think when you start trying to adjust in real short periods of time, you get yourself in trouble.
And before you jump in, Justin, on the actual expertise behind it, one point I think is really important to say is this is why, even though we're long-term investors, we're updating our plans on a real time, right? This isn't a financial plan that you set in a drawer and you revisit like an estate plan. And arguably we should revisit that on a regular basis, but it's fluid. That if your advisor isn't sitting down with you adjusting to what real returns are that have material impact on whether you're going to be able to achieve your priorities, your outcomes, you probably need to look somewhere else, because this is what we're doing every single day, is updating our clients' plans with these real returns. And the other thing that we see investors doing during these periods where returns maybe are starting to become scary or unexpected for the future in the public stock market, we see clients wanting to reach mistakenly, just saying, well, should I put my money in real estate? Should I put my money in Bitcoin? Should I put my money in these things? And realistically, what we say is we never fall in love with a specific asset class. We're asking, what are the expected returns? What are the sources of the returns driven by the risk? And are we being compensated for that risk? Ultimately, do they belong in your plan to help you achieve the outcomes and priorities? And so now I'll let you jump in there, Justin.
Yeah, no, great points across the board. I think one of the things I'll just kind of start with is you have to invest in the markets as they are. You can't invest in the markets as you want them to be. You'll probably just be sitting on cash the whole time, right? Because if you have that mindset, you're not going to invest when valuations are high. You're probably not going to invest when markets are cratering, because there's too much kind of allowing your brain to interfere with investing. And we know that is generally not a good approach to take. But I think it's super important to underscore outcomes and your overall financial structure and how we're looking at this based on what is being priced in the market. So we build portfolios that are tailored to specific client outcomes as they have identified. We then, what we do, it's called liability matching. We match your goals with assets, and we discount those things the exact same way, so they're almost immunized. Now, that is actually a financial term. I'm not just using that because we're in a pandemic and talking about vaccines and whatnot, but that is a financial term where we're basically building a boat around your goal and ensuring that it will be met with almost absolute certainty. I will never say 100% certainty, because you can't do that with life, I would argue, but investing specifically. And so we are building this portfolio structure that does essentially ensure that you're going to accomplish your outcomes as you've identified them to our advisors, right? And then we're also taking into account any excess you may have and investing that accordingly, right? Now, to Brandon's point, we might be starting at a point in the marketplace today where the forward-looking expected return is a little bit lower than it has been in the past. It is still positive, and to harp back on a point we, I think, touched on last week, where you're not likely investing all your money today or at the market peak or at the market bottom, for that matter. You're investing as you earn income, you convert your human capital into actual financial capital and put it into the portfolio and let it work over the long term. So I think those are really, really important components to think about when it comes to investing in times like this, where there are a lot of interesting headlines, I will say. Some of them can definitely worry potential investors, whether it's the debt or valuations or the pandemic, for that matter. But the way we structure portfolios, I don't want to say it completely disregards what's going on. It takes into account what is going on and what the marketplace is pricing financial assets to.
And I would argue, Justin, to support that, it's we're actually implementing what's going on in the markets today in the most appropriate way, is saying it doesn't sit in isolation. It actually impacts you. You have to save money, right? Like, the stock market and investing in general is not some magical machine that's going to overcome your lack of core money management principles, right? You save as much as possible. We maximize your after tax, how much you actually take back, is it's a part of a plan, is setting forward and saying, these are your priorities, these are your outcomes. this is what the market forward looking is probably going to provide you in expected returns.
Totally.
So we have to make real adjustments based off of tax implications, off of spending, off of your human capital. That's the biggest alteration of what's going on in COVID and in the economy and the markets, is not asking, hey, how is this going to impact my investment returns? It actually should be, how is it impacting my human capital? And so I think that's the main takeaway today, is saying, this is not looked at in isolation the same way that you are giving attention to potential investment returns. Are you looking at your human capital the same way? If you don't have your priorities defined, and you have somebody investing money on your behalf, they are absolutely guessing. They most likely, like the big brokerage homes, they gave you the option of one of the 5 models. Are you conservative? Are you aggressive? You're balanced, and you end up in a 60-40 that looks like the other 40,000 people that are clients, at the big brokerage houses. And I think that's the difference, is you've worked hard for your money. You demand excellence of yourself at what you do, and you deserve that on the advisory side. You deserve customized, tailored portfolios to meet your specific needs. And so we appreciate you guys. As always, head over to awminsights.com. Make sure that you are subscribed to the newsletter so you're staying on top of all of the information. And until next time, stay humble, stay hungry, and always be a pro.